Hi everyone, I thought it'd be good to give a video to the newsletter just in case you don't get the chance to see the newsletter on Telegram or on the program. Okay, so just wanted to share this with you. The market rises, of course, have been a surprise to everybody, despite, I think it was about a 5% fall yesterday in the Nasdaq at the time of recording this. I only put it at a 40% likelihood back in March that we'd rise, 60% that we'd fall, but it happened. The 40% happened, and am I glad I allowed 40% of it and had a full portfolio. See the previous newsletters, you can see that, loaded with leveraged versions of Amazon, Alphabet, Microsoft, Facebook, and Apple. The strategy on that is very simple. If the market fell, they wouldn't fall as far and they'd recover sooner. And if the market continued rising, well, then they'd continue rising. One of my apprentices sent this. He just started this strategy. We call it Strategy 8 because there's 7 other strategies before it. I'll explain this a little bit later on. What he's done and the time frame he's looking at and how he's made the returns. And you can see with very little funds. However, it's the notional value of the funds that matters. And I explained that, as I said, on Strategy 8. If you want to know what the notional value is, you multiply 265 by 210, which is the price at which he opened, and you'll come to about $50,000. So you can see he's got quite a large position, even though the margin requirements are low, which tells you don't look at margin, you look at your notional value. And he's got that notional value backed up by cash. So were these to go to zero, he could afford to pay off all of it. Obviously they're not going to go to zero. And why does he think they're going to rise and over what time frame? I'll explain how he's using statistical analysis that we show in Strategy 8 for that. Now, before I do that, let me explain this. That's the S&P 500, and you can see that I've said there would, of course, be declines. There always periodically are. Forget one-day declines of 5%. We're talking about slightly longer periods there. Nevertheless, despite that, and the same goes for the Dow, and where are we? Well, some slight dips as ever are expected, but upwards seems to be the norm. The Dow, I suspect some profit taking is due. Well, it's already started by the time I recorded this. I published the newsletter last week, as you know, well, on the 1st, so what is that, 3 days ago. No rocket science needed to work that out, but I would not stay out of the market for my 12-month holdings because we could keep rising, right? The MACD, which is a measure of momentum, how the prices are moving. It's got a pattern which is worth noting, and it can rise from these levels as it's done in the past when it's been at this point before. That's why I don't think it's a case of sitting on the sidelines. Equally, I don't think it's a case of going gung-ho either, because we get these periodic falls and they scare people. Okay, one other thing I want to show you is this, just out of interest. Just when crashes have happened, how big the falls have been. I'm not saying they're going to happen. I just want to remind people of the downside. I always want to know what the worst side can be. And remember, it can take a long period of time where the markets grind and grind. So if you're looking at long-term investing, we do want to have the liquidity to hold on for a prolonged period of time. But ideally, we want to have better picks. Oh, the reason I showed this was because there's brand new jacket coming out for this book published by Palgrave Macmillan. They've updated the text and the jacket cover as well. Right, what drives the market value? This was just an incidental I wanted to show. I thought it was quite interesting. How much of company market value of companies is now built up by intangible assets, things like brand awareness, intellectual property, whereas before it used to be tangible assets, things you could just glass you pick up and you can sell it. Right, and I think it's one reason why valuations have become more difficult. I think it's also one reason why sometimes the market doesn't keep up with the new world, and it's all changed. They're still used to using the old accountancy methods, and that has changed. Now, new milestone: the Nasdaq 100 surpasses its 2000 peak relative to the S&P 500. This is the ratio of the Nasdaq versus. Well, I should get a pen out, shouldn't I? Versus the S&P 500, and you can see, well, that you would think, oh, that's not good news, Alpesh. Well, the Nasdaq's technology rich, the S&P is a broader market base. Back then, technology we'd all got excited about as well, but didn't have earnings, I know, because I was doing my Bloomberg TV show. I kept saying, we know the bandwagon is going to fall off a cliff. People are just trading this to jump off the cliff before the bandwagon falls off. That was the game. We knew it was going to fall, we just didn't know when, and we knew to jump off the blasted bandwagon. Only fools stay on a falling bandwagon. The issue is, are we at the cliff yet? Well, clearly not, because we'll get these kind of jolts when we are. We don't have them, and I don't want to get out too soon either. Okay, obviously don't want to get out too soon. The US bear markets then start with a fall, then bounce within a few months before dramatic final fall. Well, I want to share this with you as well. Let me put this microphone over here so you can all hear me properly. Okay, I want to share this piece of data, very important data, with you as well. And again, you'll see in the newsletter in more detail. You can pore over this. It was done more out of interest. A few have asked me about IPOs. Be very careful. There's very little data on IPOs at the time they float, of course, as opposed to when they perform. They're not all one-way bets, as this data chart shows. So take your time to look over it. They're not one-way bets, is the point I wanted to make. With that, in terms of where's the bubble, well, here's another diagram which sort of says the opposite. This was the Nasdaq in blue from 95 to 2000, and this is the Nasdaq now. And if we were to rebase both of them, well, we've barely budged as things stand at the moment. So that could be an argument that we haven't. I'll repeat of that chart. I also wanted to tell you some of the most, if we're concerned about risk adjusted performers, which are the best in terms of risk adjustment. What do I mean by risk adjustment? We look at their returns over a particular time frame, and we look at the volatility. We divide one by the other. That gives us a risk adjusted return and tells us which are giving us the best risk adjusted return. I own virtually all of those with the exception of Nvidia, and I don't think I picked up Gilead. I don't think I picked up Gilead or Nvidia. Can't own everything, can you? Upward trajectory, well, we know they tend to go up over the long term, which is one of the reasons why I say we want to have the liquidity to hold on, but we still want to have quality so we get a good return. Highest percentage of buy ratings on the S&P 500, top 10. Here are some more names for you of those I happen to own. Alphabet, you can look at these. I've also, here, I'm going to show you in the next image, shared my own holdings and the analysis. So Lime tells you my core holdings, all ones which are 7, 8, and 9 rating, up over the past week, 2 weeks, 3, and 6 months. Orange tells you what I own, just so I can disclose that. And yellow, what are 7, 8, 9, and do not show crazy high overbought momentum. You'll want to look at this in your own time, carefully and slowly on the Telegram channel or on the program itself. Okay, I'm just showing you that it's there. It's in the newsletter. Some of you missed the newsletter because you don't look at Telegram, you don't look at the program frequently, and so on. So I just wanted to do this video to make sure you know it's there as well. Here's a range. That was the strategy I promised to explain at the start of this webinar. Okay, so you've got a typical range. 2 standard deviations of price movements will tell you that there's a 95% range in 1 year that this particular stock will vary between those 2 price points. Okay, and it's Microsoft we're talking about. And where will Microsoft share price be? Useful analysis to work out with your capital how much leverage is sensible on, for instance, CFDs. Now, so on the basis only 5% chance will drop more than 30%. There you go. Well, there's actually less than a 5% chance it will drop more than 30%. But let's say 5% chance it'll drop more than 30%. And let's say you use 10,000 to buy CFDs to control 100,000 notional value, because you only have to put a deposit down like a house when you're doing CFDs. This is high risk strategy, but I'm explaining it to you so you can determine whether it's suitable for you or not, giving you the education. Microsoft stock, then, were it to fall 30%, you better have an additional 20k at hand, because you only put 10k in margin, but because you controlled 100k, if it drops 30%, which is there's a 5% chance it could, you better have that extra 20k in hand, because the broker's going to come asking for it. Were it to rise 30%, you would make 30k on your 10k capital. All right, that's simple. There's more of it on that website, but I just wanted to explain all of that to you. I always end my newsletter with a personal note. Well, it's all Zoom. But this was only at the back end of 2019. Can you believe? I was in South Korea, Hong Kong, India, Lebanon, talking about investments and investing and all the rest of it. It just seems so long ago. Okay, that's an overview of the newsletter. I hope you agree it's worth reading in more detail. Like I said, always keep an eye on the program. Keep an eye on the on Telegram. If you don't, you're going to miss quality stuff like this.